Have you ever wondered how the timing of your investments could impact your returns? Whether you're a seasoned investor or just starting out, understanding the relationship between when you invest and how long you hold your investments can make a huge difference in your financial success. In this video, we'll dive into a revealing chart that shows exactly how the year you start investing and the length of your holding period can affect your annual percentage yield. Stick around to discover the key strategies that can help you maximize your stock market returns no matter when you start on Simply Money. But thank you for joining me on Simply Money. Today we're going to look at an interesting chart. It's an APY chart. It goes back to 1993, and we're going to look at different scenarios of if you had invested in the stock market back in 1993 or any year up until 2023, and we'll look at various lengths of time of holding that and what your annualized return would have looked like. The APY changes drastically from year to year depending on when you invested and how long you held it. Now, this video isn't about trying to time the market. I am not a fan of trying to time the market. I am all about dollar cost averaging, DCA, consistently buy into an ETF, an index fund, a mutual fund, consistently put a certain amount of money in, whether it's weekly, putting $100 in, monthly, putting $400 in, quarterly, putting $1,200 in. It doesn't matter. Just being consistent, because that dollar cost averaging means you're going to buy sometimes when the market's a little bit higher. You're going to buy sometimes when the market's dipped a little bit, but it averages out from purchase to purchase. And over a long period of time, you've slowly invested and allowed your money to compound and see that growth you're looking for. So let's get started. So let's look at the chart. First, we're going to start right here in 1993. You can see going across the top of the page is the year that you invested in the stock market. And then going down the left column, you can see how many years you held it. So you can take this chart and look at any scenario of when you started and how long you held it. So if you purchased in 1993 and you held the stock for 1 year, you can see there you would have got a 10% annual percentage rate. If you had held it for 2 years, you would have got a 6%. Now, the reason you can see that is because in 1994, if you'd held it for 1 year, you'd only got 1%. So this 10%, this 1%, this averages the APY up to 6% if you had held for 2 years going through these two scenarios. But then look what happens in 1995. If you bought in 1995 and held it for 1 year, you would have received a 38% APY. What that did to the 1993 purchase was it brought it back up to an APY of 15%. So that's where the longevity, as you hold, you begin to get an annualized percentage rate that balances out the lows of like 1994 and the highs of 1995 to give you a nice average of 15%. So we're going to look down here at the chart at the bottom. In 1993, if you had held this for 31 years, your average return would have been 10%. Again, that's a nice return, a nice average, long-term buy and hold strategy. And you can see over the last few years, it pretty much averaged anywhere from 8 to 11% for a good bit of the time. Almost the entire time, it was anywhere between 8 and 11%. It had some highs, it had some lows, and you can kind of see if you go along the top line what each year ended up producing. So you had the 10%, 1%. The 90s were great. Mid-90s, 38, 23, 33, 29, 21. But then we had the dot-com bubble of 2000, 2001, 2002. You can see how drastic that was. So if you had purchased in 1991 and held for 1 year, you got 21%. But if you held for 2 years because of this 9%, you got 5%. Now let's look at this. 1999, we're going to pretend that's when we bought. Oh, you think, oh, what a great year. I got 21%. Then negative 9% hits and you become discouraged because your APY now is 5%. But it gets worse. The next year, negative 12%. So now your APY is negative 1%, and then negative 22%. But now you've averaged negative 7%. So if you had bond in 1999 and you held it for 4 years and you get scared, you get discouraged, you think, I'm out of this, you lost 7%. But then 2003 has a nice recovery of 29%. That brings you back to negative 1%. But even a nice full year didn't fully get you back to where you started. And as you can see, this would have been one of the worst times to invest. And that's what's called sequence of returns. People focus on sequence of returns when they're getting ready to retire, when they're getting ready to withdraw their money, but it also impacts on the growth of your money. So as you can see, if you go down here for 12 years, you would have only been up 2%. But this is where the buy and hold strategy comes in. It takes time, but if you had bought and then you'd held for 25 years, you would have been at 8% return. Now that's not fantastic, but it's still a nice consistent growth over long term. 8% return would have grown your money and compounded your money over those 25 years. And that's in a bad scenario time of buying. So the sequence of returns, meaning the next few years were horrible years. So you started out, you invested, and you were down at one point after 4 years, 7%. And that can be devastating. You're not buying for 4 years. You're not investing in the stock market for 4 years. You're investing for long term. So let's look at 2002. Let's say you started investing in 2002. In your first year, you're down negative 22%. Well, then it has to recover the next year, brings you to 0%. So you basically, after 2 years, you're even. As we go down, you can see the continual climbing slowly out of that hole. But then we hit the housing bubble, 2008, negative 37% really drops this down. But then it begins to climb. And as you can see, when we go down, and we hold it for years, we get back up to the 9, 10, 8, 9% return over long term. The next thing I want to show you is this kind of bottom line here. As you can see, at 31 years, the longest we have to go back, and we go all the way up to the most recent years, 2023, you can see this year, 26%. This year, 2%. See how much more volatile, because you're a short-term number of years. But if you go down as far back as you can, and we're looking at a 31-year investment. So this is a 31-year investment, 10%. 30-year investment, 10%. 29, 10%. 28, 10%. 9, 8, 7, 8. So 22 years, 9%, 11%. Do you see what's happening here? The longer you go, the longer you hold, your APY begins to flatten out. It begins to become more predictable. If you're looking anywhere from 16 to 31 years, you have a range of 7 to 11% on this chart. This is using the S&P 500 as an example. So something like SPY, of that nature, some sort of index that is based on the S&P 500, you can see that you're looking at about a 10% return rate. If you look at anywhere from 10 years to 31 years, you have a 7 to 14% return. But when you go into investing, you want to diversify. We have different videos to offer, educating you on investments, on saving, on getting out of debt. But this is a key element to your wealth growth, and that is investment and getting a return that outpaces inflation. And the S&P 500 is a great tool that can pretty much put you at a place where you're going to get 10% return. Again, from year to year, it's going to fluctuate. 10 years to 20 years, it may fluctuate. If you went 24 years from that particular year, you would have got 7% return. But if you held longer, you're going to get to that 10% average. As you can see, as we get down here, we're at 10%, 10%, 10%, 10%. That is the number you're seeing here predominantly. There's some short-term higher gains and there's some middle ground here. And this is kind of your worst scenario is you're looking at 7 to 8% on the low end. And that would be the worst timing. You invested in 1999, you had to wait 24 years and you wanted to retire. That would be your worst scenario and you return 7%. So again, there's fluctuation in this, but this is a great chart to give you an idea of how things fluctuate and to look at where you're at and realize I may be in this 1%, I might be in the red. But look at this chart. Look how much green there is. Overall, the S&P 500 is going to keep you in the green. The only time you're in the red is short term. The worst scenario is this 10-year time frame right here, where you're at negative 1%. That is worst case scenario. Don't live in the worst case scenario knowing that you have the opportunity to build your wealth and allow time and compounding to impact your ability to achieve financial freedom. I hope this chart's helpful. I hope it enlightens you. I hope it makes sense to you. If you have any questions or comments, put them down in the link below. Leave me a comment, ask me questions, and please hit the like and subscribe button. It helps the channel and helps us produce more videos like this. Thank you for joining me on Simply Money, and we'll see you next time.